for now, let me introduce the first panel, which is about who is buying tokenized money market funds and why. So I'd invite them all up to the stage to join for the first panel. Really looking forward to it. I think you have an absolutely cracking panel here. And let's find out, why are people buying them?
All right. Hello and welcome, everybody. Very happy to be here and be able to speak about the topic of tokenized money market funds with you. I think this is one of the most interesting topics when it comes to financial institutions, exploring this space, exploring what do we issue and how do we start with the issuance of tokenized securities. Together with me on the panel, we have Matthew. So Matthew, would you like to introduce yourself?
Hey, good afternoon. Matt Horne. I run the digital asset strategist team in Fidelity Digital Asset Management based out of Boston. We're doing a few things in this space, launching exchange traded products, for layer one type exposure, but also most recently we launched a tokenized money market fund back in August with about $200 million in assets right now. So a lot of fun, interesting things going on, and hopefully I can add some insight here.
Thank you. And Natasha?
Hi everyone, I'm Natasha Benson. I'm the COO and CFO of Ownera. I'm also the product manager for our collateral mobility application. I'm sure you heard Ami earlier talk about Ownera. We're essentially interoperability layer that provides the connective tissue to organizations for their blockchain strategies and also connecting into traditional infrastructure. So nice to be here.
Thank you, Natasha. And Simon?
Hi everyone, Simon Keefe. So I head up digital solutions at Calastone. For those of you that don't know Calastone, we are the world's biggest funds connectivity infrastructure. We have a network of about 5,000 participants in the traditional asset management ecosystem, and we do about 15 million transactions per month in the traditional world. And my job, I'm very lucky, I get to travel the world meeting and working with a lot of our big asset management clients to help them deploy their digital strategy. And by far the biggest part of that is tokenization. And the conversation is always, how do I get my funds seamlessly on chain? And then where is the money coming from?
Thank you, Simon. Daniel?
So I'm Daniel Coheur. I'm global head of digital assets for Apex and fund distribution. I've also co-founded a company called Tokeny that has been acquired in May by Apex. So for those who are not familiar with Apex, this is the larger privately owned asset service in the world. We have 3.2 trillion of assets under management for 30,000 funds, for 14,000 clients, and we operate in 52 countries. And I'm probably also the only guy wearing a T-shirt in this audience.
We've gone from one extreme to the other here.
It's a nice T-shirt, though, so.
You're talking about 83, right? 3.0?
There we go. There we go. All right. So I think there's been a lot of hype around the topic of tokenized money market funds. Everybody's talking about it. Everybody's interested in it. But then when you look at the stats, you see that actually maybe only 5 billion, between 5 and 7 billion of AUM actually exists today in tokenized money market funds. And when you compare that to the traditional size of money market funds, I think that's still pretty small. So Matthew, I'm going to be looking at you with the question of you are building a tokenized money market fund. So we'd like to know, you'd like to tell the audience on who's buying that tokenized money market fund.
It's a great question. It's the big question. I think when you think about distribution of these on-chain products, you have to figure out kind of who you can serve at a point in time, right? So I think right now the biggest opportunity, at least in the U.S., is post-Genius Act, which was the legislation that went through in the summer that gave clarity to how to launch a stablecoin and the rules around managing the reserve collateral. That sort of became a really immediate use case for money market funds in this space, and there are obviously benefits if you have a stablecoin to having your reserve asset on chain as well. So I think that is the immediate use case right now, and we're having tons of conversations in that space. If you look at just the direction of travel with stablecoins and where this could go, it could be, and I think right now it's a $250 billion category, probably going to $1 trillion in the next 2 or 3 years, and maybe $5 trillion in 10, right? So if you're a money market issuer, you want to be levered or have leverage to that space as it grows. So As more stablecoins get issued, money market tokens, ideally could be part of that reserve collateral management. So I think that's a definite use case that we're talking about right now and seeing usage of.
Yeah, very interesting. Maybe Simon, you'd like to say a few words about that as well?
Yeah, absolutely. As I say, this is literally the $100 billion question. I guess we get asked by asset managers all the time. And we, from a traditional kind of network, who moved into the tokenization space and the digital space, we're getting now as many inbound DeFi contacts as we are from the traditional world, which shows you kind of that things are moving forward. And being a lover of stats, and we were told to bring some stats, and I don't like to disappoint, we've recently undertaken a survey of asset managers and DeFi venues. Asset managers get it, they're on board, but they're all saying, where is the demand? But interestingly, on the DeFi side, it's something like 80% of DeFi treasurers want to trade into tokenized money market funds from their own treasury. And that's not just stable coins, that's blockchain foundations and DeFi companies, one of whom I'm sure is sitting next to me here, that all back that up. But only 25% are today, and not necessarily on digital rails. So the opportunity is already there, it's already big, and that's only going to grow with the stable coins that Matthew mentioned.
Very interesting. Natasha, you want to say something?
Maybe just to jump in on that, as my role of CFO, one of the things I'm often looking for is nice, stable income for our treasury balances, and unfortunately the deposit accounts are not paying the yield of the money market funds. So actually we've worked in partnership with Artax, I can see a few of them in the audience, to actually get tokenized money market funds into our own treasury, which is game-changing really for us. It means that I actually can buy something that has got utility to it and yield.
Yeah, for sure. And I think this is the main use case right now for money market funds, is a place where stablecoin users can also park their cash and earn yield on it, right? So I think I forgot to introduce myself as we were starting this panel. So my name is Elie, I work at ABN AMRO, and I'm currently working on an initiative for tokenized money market funds as well. So hopefully we will be able to launch our tokenized money market fund before the end of this year. But as we were building this fund, I think we are also partnering with Daniel. So Daniel helps us build our tokenized solutions at ABN AMRO. And when we were thinking about building the tokenized money market fund, Daniel and I, we were having this conversation about where can they be used, and typically in the area of cash at movement versus cash at rest, right? So where are tokenized money market funds being used today, and where do we see them used in the future? And I think, Daniel, maybe we can also shed some light on that.
Yeah, sure. So obviously, Matthew was referring to the development with Guard Genius Act. We've been having MiCA for quite some time in Europe already. So now we have stablecoin and non-yielding, right? If I think about 20, 30 years back, when I was working at Clearstream, we had every day this 4 p.m. cutoff time. So everyone had to share their balance at 4 p.m. to the Treasury Management Department, and they were, of course, collecting all those balance and investing overnight. And still today, and maybe you can confirm that on my friend from Clearstream, if it's not the biggest revenue of Clearstream is this overnight cash placement, right? Now we have stablecoin and I'm not yielding anymore, so you don't want to stay with your stablecoin on, because obviously we know how much this is yielding. We just have to look at Tether balance sheet and look at why they are the most profitable company in the world. So you want to be capable of getting the yield for your cash. So clearly the alternative now is to invest in money market fund. So you don't have this cut of time anymore at 4 p.m. because your cash is always on, and you will now have those money market funds that you can invest 24/7 and place your treasury without any dependency indeed from other departments or from any cut of time that exists in the world. So what we're looking at is truly a paradigm shift in the way that treasury management are investing and managing their treasury using stablecoin and money market funds. So it's a game changer for large corporations, it's a game changer for banks as well. So that's why we see so many demand for money market fund, pushed, of course, by this new regulation that prevents those stablecoin from yielding and bearing interest.
Very interesting. Simon, you want to say something?
Yeah, and I was just going to add to Daniel's point, which I absolutely agree with, that's absolutely true. And I think if you look at kind of at least 4 of us on the panel, well, 5 of us from Natasha's previous background, the key is that this has to work with traditional finance as it is today as well. Absolutely in the future, when we've got everything totally digital and on-chain, from the underlying assets all the way through the value chain, and we get all of the economies of that, efficiencies, and then we can distribute natively on chain. We're not totally there yet. There's a lot of kind of funds being started up on digitally, fully on chain, but to link into the real big kind of institutional funds, you need that connectivity to make that work. And to make that work in real time isn't easy for the transfer agents. So we have to kind of be cognizant of that as we move forward and make sure that we are working across the industry to make that happen.
So just thinking as a fund issuer, just an asset manager in general and looking forward, you know, I think one has to consider the token as a new distribution vehicle, just like ETFs disrupted mutual funds. And if you remember, that took time. The first ETF in the US was 1993, and I would argue it wasn't really that disruptive until maybe a decade or 15 years later. Now it's the preferred vehicle of choice. And I think you could see a similar run rate with tokens over time. And it's not just a better vehicle potentially than ETFs. It's global, it's 24/7. It creates massive opportunities for global distribution for asset managers who may not have been global distributors before. So it's something that, you know, we're focused on keenly. I think other big competitors are as well. But it's going to take time, and it's not an easy problem to solve because you're taking, you know, an analog kind of TA system, and trying to get it to talk in real time. So it's on-chain, so it's hard.
I mean, here also it's interesting to think about this problem from a regulatory perspective, right? So this question about the TA being analog, I mean, for instance, in Germany, we don't have that problem anymore, right? This is due to the EWPG regime that's there, where actually right now, if you have an EWPG license, you can issue tokens natively on chain, and then settlement basically is executed once a token moves from one wallet to the next. And I think this is a huge efficiency that exists within the German landscape. And it would be interesting to see how we can actually see more companies or more jurisdictions adopting similar regulations to eventually enable, let's say, the real use cases or the real adoption of this tech. So interesting one to keep an eye out for. But then, Natasha, I turn to you, and I know that there's quite some work that has been done with Ownera, with GDF, about the topic of tokenized money market funds as collateral for derivatives. So maybe you can tell us more about that?
Yeah, I think what we're seeing now is a shift in focus away from tokenized assets as a purchasing vehicle to actually the utility of tokenized instruments. And so we're starting with tokenized money market funds. It will be soon tokenized gilts and other treasury instruments. And then over time, it's going to move into real-world asset use cases. And we always segment our business between the liquidity use cases and then the real-world asset distribution use cases. Through the GDF project, what we were able to demonstrate was this is a $1 trillion industry in terms of derivatives margin. On a daily basis, I think another stat for you, Simon, there's about 400,000 daily margin movements, all of which are fairly manual in nature. There's beautiful optimization tools, but they still sit on legacy rails. So it still takes T+1 to settle a bond trade. Most institutions are posting cash for variation margin, hugely inefficient from those organizations. And what you tend to see is in a market stress event, the fund managers are liquidating money market funds to post to the banks in cash format for then the banks to repurchase the same money market funds and the same treasuries. And you've got all that bid-offer spread leakage going on in that flow. You've got that time of inefficiency. You've got all the counterparty risk in those hops. And actually what you can do instead is say, well, I've got this lovely money market fund here. I'm just going to give it to you over here. And you might think that that happens today. Unfortunately, it doesn't. So today you can post money market funds as derivatives margin in Europe, but it's all done within silos. So only if you are on an account with a custodian can you receive that. And it's still immobilized at that custodian and then moved via a pledge or some sort of custodial agreement. What we've seen in the recent months is products like Benji in Luxembourg come to market, fully digitally native. The TA keeps a golden source, really changing the way that money market funds are issued. And what we've done with that is through the GDF working group and the sandbox is transfer a money market fund from Commerce Bank to UBS to then rehypothecate that same money market fund into an intraday financing agreement with State Street. That's absolutely game-changing for this market. Indeed. It really changes how treasuries manage their cash and intraday liquidity. So we're going to see more and more of this, and I recommend to any asset manager to look at this paper that's coming out by GDF in a couple of weeks' time. Look at the detail, because it is very thorough in terms of legal analysis, going through exactly what is good, what isn't so good. There are a few jurisdictions that need to get their act in gear, I have to say, to really set out the framework for this. And then actually, by the end of the year, we're going to extend this project into the US. So the CFTC have actually put a comment paper out to say, what does tokenized money market funds need to look like for collateral eligibility? Let's work on this. GDF and ISDA are going to be co-chairing this piece of work. So I welcome everyone to get involved.
Very interesting. Somebody else would like to say something about collateral?
Yeah, again, 100% agree. And we've been kind of part of that GDF group as well. And it is the immediate opportunity, and I'd say probably larger than $1 trillion. It's enormous. But again, I think it's key, going back to that point, that for the time being, we have to bring the traditional infrastructure along with us as well, because we can launch on-chain funds, and that's great, but where the big money is already sitting in those large industrial-sized funds that can be used, and they can be kind of transitioned on-chain pretty easily, pretty simply. And a point that you made right at the start, Elie, was, why haven't the existing funds taken off? Well, they were the standard bearers, but if you look at the infrastructure that was put in place, it made it a little bit expensive to go and buy those money market funds compared to the traditional versions. We're beyond that now with models that Calastone and others have put in place, and Apex, to make it kind of on a par. So if you can use those traditional existing funds in the collateral space on-chain, without a big uplift, without the asset manager having to launch a brand new fund and go through all of the processes that involves, that's an even bigger game changer.
Yeah, I agree, but then my question to you would be, so where does the settlement actually happen? So if you tokenize an already existing money market fund, are you not just adding another step to the settlement, or like, how do you see that?
So as long as you're integrated to the transfer agent, right? That's going back, I hate to bring it back to the transfer agent, because I know there's a few here. But you have to be tightly integrated to make that happen. And I honestly don't think, and we'd love to move everything to digital tomorrow, but I honestly don't think that's going to happen overnight, if we're realistic. And we have to kind of be cognizant of that traditional world, and having the transfer agents as part of this group, and being able to integrate tightly to them, and bring them on that journey, and they will eventually move to a fully digital solution, but we have to bring them along, because otherwise we'll be sitting here in 3 years' time and we might have 10 billion in collateral rather than 2 trillion.
I agree. Would you like to say something about this, Daniel?
Well, we are working on a number of use cases with liquidity providers and DeFi protocol to use money market funding to those DeFi protocol. Obviously, this is not so much of a technology complexity. It's more mapping the process that exists with transfer agent and bring that into the DeFi world. You know that we at Tokenised have been developing the ERC-3643, which is based on identity. We believe is very important, especially in DeFi protocol, because those tokens cannot circulate freely. If there is a transfer of ownership happening because you have a liquidity providers that is responding to a margin call, and you transfer the ownership of the collateral money market fund to the liquidity providers, then obviously the ownership doesn't change in the book of record of the TA. So you need to identify the liquidity providers prior to the transfer ownership, and when the transfer of ownership is happening, then the TA knows that he has to transfer the ownership, and if obviously the liquidators want redemption, then he will obviously will redeem and pay back to the liquidity providers. But we cannot pay back to someone that is not in the book of records, so we first have to transfer the ownership. So that's why you need to map that with proper identity. We were referring earlier that this industry is moving to a wallet type of infrastructure. I wouldn't necessarily agree with that. The wallet is a technical thing that enables you to sign transaction on chain, but it has been badly associated with custody, because on permissionless chain like Bitcoin, your private key is your ownership. You lose your private key, you lose your assets, right? If you work with an identity and a level of permissioning on the chain, which is enabled by the ERC-3643, which again is necessary because you have asset servicers that are mandated to service those assets, so the control function must be centralized. You also need something that is using an identity so you can transfer the ownership relationship to an identity that is properly identified, KYC, AML, and not a wallet, which obviously in most cases is anonymous. At least in the DeFi world, it is anonymous. Maybe big guys will argue that it's not anonymous in the infrastructure. That is true, because they whitelist the wallet, they know who this is, but they don't know who it belongs to in the other infrastructure. So if we look at this as a global infrastructure play, and we look at DeFi where those tokens will circulate through various infrastructure, you need to be able to identify that. So so that's something that we need to look at, and that's why some people are saying, why are things not moving forward? Because there is a lot of complexity in implementing behind the scene so that the user can focus on the value creation and not on the technicality. That's why obviously Apex acquire us.
I suppose just to jump in there as well, I think the key thing is also those investors need to have a unified way to access all of these different instruments. What we've seen, and I think someone mentioned it earlier, every Monday now there is a new blockchain launched with a new fund that is launched on said blockchain. That's not helpful in the industry at all. And yeah, there's lots of ways of bridging across these different networks, but actually you don't want to introduce counterparty risk. You want something that's keeping pure to the source blockchain, that goes back to Daniel's point around the TA, always maintaining that golden source, that golden record. So it's absolutely important that there's interoperability between these systems such that you can, as an investor, almost disregard the blockchain. Like, as an investor, as a CFO, I don't really care which blockchain it's issued on, as long as I've got perfected title and I know this asset in an insolvency is going to be mine and I can do something with it. I don't want a bridge in the middle. I don't want an oracle or anyone else managing my cash for me or my assets. So it's got to go back to the source. The TA actually is super relevant in this new world in terms of what their roles and responsibilities are going to be.
Sorry, just 1 second. I was going to say exactly the same thing. We can't introduce a model that's worse than the existing model and put extra risk in place. That just will not work whatsoever. So the TA has to be involved. And I think in the conversations we have with banks, in particular with investment banks, there is still a reluctance on public chains, rightly or wrongly, because they don't want, although it's anonymous, etc., they don't want their positions visible.
Yeah, for sure.
Across the world. So that's why you're seeing some of these collateral networks appear on public permission chains and private chains as well. So but we will solve that. We just have to get there.
I think privacy is definitely one of the most interesting topics in public chains right now. And if the future of finance will indeed be on public chains, privacy needs to be solved, because we don't really announce what are we buying and how much are we buying it for, right?
That's work in progress.
Yeah,
obviously, coming back to the RC3643, we have an association with 150 members now, and we have a couple of members that are working on privacy solution. Maybe you have heard about full homomorphic encryption, which bring privacy on public chain. Until now, you had to upgrade infrastructure at node level to implement that cryptographic mechanism. Now they're bringing this at smart contract level. We're working actually with Zama, which is probably one of the most funded, largely funded company in the industry, to implement those solutions. And it's around the corner. We already are capable of bringing confidentiality on a basic ERC20. And I believe that in the next 4 or 5 months, we will have solutions to create confidentiality on public chain.
Yeah, and I think this would indeed also help unleash the adoption of public chains. But Matthew, do you want to say something about collateral, or would you rather talk about, let's say, when we see tokenized money market funds as an instrument that is even available for retail customers? So do you see retail customers right now in your client list? Are you prospecting them as potential clients, or is this something for later on?
That's a bit later on. Right now, we're focused on institutional use cases. So, $1 million minimum. We're generally going after crypto-oriented type use cases in this space. But the challenge we have, right, is everyone has used a stable coin for the most part, and it's very seamless. Once you move into a money market token, you're dealing with securities, right? And you have to, and it becomes a higher friction process. And this idea of on-chain identity and KYC and the ability to kind of have the fund issuer know who owns their product at all times so they can, meet all the compliance issues. It's not an easy problem to solve. And if you have these walled gardens, it gets harder, and it's a new set of problems and a poor user experience. So these things take time to work out. Retail, I think that's the holy grail over time, is once you figure it out on the institutional side, you can go down market to retail and truly, unleash, peer-to-peer, DeFi use cases, et cetera. But I think you have to get it right for these institutional use cases.
Just to jump in on that personal experience, I was redeeming some of my own portfolio this week and coming out of some risky positions and wanted to go into money market funds. It took 5 days to settle the money market fund with my traditional organisation. I won't name names.
Which well, we once we know.
Not
it
State
should
Street.
be the same day on money market funds, even in the traditional world, which is what I'm saying, we can't make it worse.
Yeah.
Money market funds are
terrible,
pretty good today
terrible.
at T+0, so...
Yeah,
Probably has a retail account, right? So that's why it was
it was a
taking
retail
fine.
account, and I think actually it's not the money fund that was the problem. It was the institution wrapping the money market fund that was the problem, and also the fees that are then taken out. So it actually was quite frustrating. Whereas actually, again, if you can buy the tokenized money market fund as a retail investor, then you start to trade it like you do your Bitcoin. You could have it in your Bitcoin wallet as alongside and be able to trade in and out. Where we are seeing some of the utility now is that interest paid by the minute on some of those funds. And again, calling out Franklin in terms of their structure, we are seeing traders jump in on that and say, well, okay, so my idle cash now can earn yield intraday.
Exactly.
Whether it is by buying tokenized money market funds intraday or even doing intraday repo, suddenly they're actually making spread and saying this is almost free money to me. I'm not taking any additional risk. I'm actually collateralizing my risk. I'm getting paid extra intraday. So it is a game-changing market at the moment.
Do you want another retail stat quickly? On
Sure.
retail. So in our survey on the DeFi side, I think it's something like 77% of DeFi venues and platforms see tokenized money market funds as a key strategy to retain clients going forward. And 40% see it as an opportunity to gain new clients. So that goes back, I think, to everything we were saying about kind of money at rest. And that is absolutely the future. But to Matthew's point, it's a bit of a way off on the size of the AUM.
Yeah, I think the idea of having, let's say, a money market fund and a payment leg working seamlessly together, and then being able to program that on a blockchain, so whenever you need to make a payment, you immediately step out of your money market fund position, make that payment, and whenever you receive that payment, then it's automatically then back converted into a money market fund, is a holy grail that we're all, let's say, looking forward to seeing, but we all agree, I think, that it's a bit down the line, and because we need to solve identity problems, we need to solve integration with transfer agent roles, so on and so forth, and make that even more seamless. But I guess we have a few more minutes on our panel, and this is an interesting topic, so maybe somebody from the audience would like to ask a question to our panelist, if that's Christoph. Always on point, Christoph.
So I've got a couple of thoughts on that because we've been looking at this for a number of years, actually. And it's an absolute opportunity for tokenized money market funds to act as that payment leg. I think there's two things that stop it. The obvious one is regulation. So the regulation has to be there. And if the US goes ahead with the Genius Act and say that tokenized money market funds can't be used as payment, then that kills it in the US. Secondly, it's the AML KYC point. So you have to, if you're holding a fund, be it tokenized or not, the asset manager needs to put you through the AML KYC process. And again, that will get solved as we get scale over time, but it's not going to be immediate that you want to deal with millions of end clients as an asset manager.
Well, you have a very good question, Christoph, but what is the difference between a money market fund and a stable coin? Regulation on money market fund in the US is dating back 1940. Because in essence, you know, if you have an instrument that is represented by 30% of cash, which is what Mika is defining, and 70% by liquid instruments, well, that's very close to a money market fund, right? So what is the difference?
Yeah, I mean, I think the main difference is one is a bearer instrument and one is not. One, you can just, let's say, immediately transfer it between clients, and then the other one, you need to transfer the books of a transfer agent to actually own that fund, and then you need to be onboarded on that transfer agent book.
True, but then you have electronic money, which is also defined by Mika, which is backed by, you know, fiat, one-to-one, that could serve the, you know, the idea of having a bearer instrument or bearer representation of cash that can be used for settlement, which in this case, you know, is indeed just to move cash faster and invest in money market fund and have proper regulation, right?
And that's one of the problems, right? We haven't got regulatory clarity. So everyone's looking at this in a different way. In the US, it's all about stable coins and the Genius Act. In Europe, there's several different flavours, including digital euro. And in the UK now, we seem to be a little bit focused on tokenised deposits, but there are some stable coins starting to come up in the UK. So regulatory clarity would also help enormously.
Yeah, I think we need to finish. I think if they let us speak, we can speak until the end of the day. But thank you very much, lady and gentlemen, for your time. Thank you very much.